Is firing the Fed chair a stagflation shock?
So a stagflation shock is by definition that inflation will go up and GDP growth will go down. But if you fire the Fed chair, as we saw yesterday, the dollar will likely go down. And at the same time, long rates will be going up. And the dollar going down is certainly inflationary. But rates going up is, of course, holding back growth. So firing the Fed chair will probably mainly mean a decline in the dollar and an increase in long rates.
Let's talk about the stag versus deflation. Do you expect to see that inflation for very long?
Well, so far there's a number of FOMC members, when they talk about this, that they discuss what is the persistence of the stagflation shock. In other words, when tariffs start to be more visible in the data. And I absolutely believe the data we just got this week, it is the case that we're now seeing lift off in inflation in goods, because we are seeing goods inflation, which makes up 40% of the CPI basket, seeing on a number of different categories, tools, toys, apparel, furniture. We've seen a fairly decent rise. And if we begin to see that lift off now over the next several months, then the risk is, of course, that this becomes more persistent. And Beth Hammack from the Cleveland Fed has said that in her district, companies that are exposed to tariffs have been raising prices, but even companies that are not exposed to tariffs have, for competitive reasons, also been raising prices because, hey, if others are doing it, we can also do it. So the fear at the Fed is that this does become more persistent and more sticky. So that's why it's so difficult for the Fed to go out and declare victory and say, oh, this is just temporary. They need to wait to see the peak, and we are really only at the takeoff stage. So we have not seen the peak. The consensus expects that later this year, by probably November or December. But the bottom line is, before we can see that peak in sight, it is not clear that the Fed will say that now we're going to cut rates more meaningfully.
How do we explain what's happening with services prices?
Well, so of course, when something has a weight of 40%, and we know very well that that's now going up, of course, the issue is, well, what about the 60%? Is that also going up? The 60% consists to a large degree also of wages. And what we know from deportations, of course, at a run rate of around 1 million people in 2025, that means that wage inflation will likely begin to go up in the areas where unauthorized immigrants are working, for example, in agriculture, construction, leisure and hospitality. So the fear you can have is that it's not only goods inflation coming from tariffs, it's also the upside risk to services inflation coming from wages, especially because of deportations potentially beginning to play a more significant role.